Thank you all for attending the Alconics financial results briefing for the fiscal year ended March 31st, 2026. First, I'll provide an overview of financial results for the fiscal year ended March 2026. Please refer to page 3 of the materials. I will now explain the summary of our financial results for the fiscal year ended March 2026. As shown here, the overall business environment was impacted by tariffs and the slowdown in the North American EV market, and automobile-related businesses showed sluggish growth. However, aluminum to copper and scrap market conditions, which had been sluggish in the first half, trended toward recovery from the second half onward. Transactions in minor metals, such as tungsten, remained strong, and semiconductor mounting equipment for data centers expanded, resulting in increases in both revenue and profit from the top line down. Net sales did not show strong growth due to the weak first half performance in aluminum and copper-related transactions, which account for a large portion of total sales. However, operating profit increased significantly by 40.8% year-over-year due to contributions from the highly profitable electronic and advanced materials and metal processing businesses, resulting in net profit for the period increasing 16.5% year-over-year to 5,598 million yen. In addition, operating profit margin improved 0.9 percentage points YoE to 4.4%, reflecting greater profitability. Regarding our earnings forecast for the current fiscal year, in light of the external environment and the progress of growth investment projects, we have revised the previously announced FY 327's recurring profit forecast from 11 billion yen to 10 billion yen. Profit attributable to owners of parent is projected to increase 17.9% year-over-year to 6.6 billion yen. Regarding dividends, we plan to increase the interim dividend by 10 yen from the previous fiscal year and increase the year-end dividend by 3 yen from the initial plan of 42 yen to 45 yen per share, resulting in an annual dividend of 87 yen per share. Next, an overview of our financial results is shown on page 4. Net sales and other figures were as discussed earlier, while EBITDA amounted to 14.519 billion yen, up 23.7% YoY. As shown in the right column, all line items from the top line down came in above the initial forecast. Next, I will explain the changes in ordinary profit. As for the factors contributing most significantly to the increase, namely improvements in market conditions and margins, the recovery in yen-denominated nickel transactions compared with the previous year, and the surge in minor metal market prices were the main drivers of profit growth. In addition, contributions were made by the metal processing business, including parts for semiconductor mounting equipment, press-formed parts for batteries, and metal processed products for aviation, space, and defense applications. Meanwhile, personnel expenses, which were a factor contributing to the decline in profit, increased as an investment in human capital. In addition, personnel expenses within SG&A expenses increased, and soaring raw material and energy-related costs weighed down profits. Overall, profit increased by approximately 1.4 billion yen compared with the previous fiscal year. Next, I will explain the overview of segment performance. Of the two businesses in the trading segment, the electronic and advanced materials business recorded strong performance in minor metals and battery-related transactions, resulting in sales of 39.763 billion yen, up 24.1% year-on-year. Segment profit increased 28.6% year-over-year to 2.875 billion yen, as profitability recovered on the back of strong minor metal and battery-related transactions and rising nickel market prices. The aluminum and copper business recorded sales of 90.601 billion yen, up 9.7% year-on-year due to rising aluminum and copper market prices and a recovery in demand for copper scrap. Despite signs of recovery in the current period, Segment profit decreased due to sluggish profit margins in the first half and a decline in demand for automobile-related products. As a result, the trading segment as a whole recorded a 13.7% year-over-year increase in net sales and a 3.0% year-over-year increase in segment profit. Next, I will explain an overview of the performance of the manufacturing segment. Of the two businesses under the manufacturing segment, the equipment and materials business recorded sales of 48.428 billion yen, up 5.7% year-over-year, driven by plating materials and non-destructive testing materials in the North American market. Despite factors contributing to higher sales, segment profit decreased 7.9% year-over-year to 1.482 billion yen due to the weak performance of the carbon brush business. The metal processing business recorded sales of 40.926 billion yen, up 11.9% year-over-year, driven by expanding transactions in chip mounter parts and battery stamped parts. In addition, growth in aviation, space, and defense-related metal processed products contributed, resulting in a significant increase in segment profit, up 42.9% year-on-year to 4.63 billion yen. Overall, the manufacturing segment recorded an 8.4% year-on-year increase in net sales and a 26.0% year-on-year increase in segment profit. Next, on page 9, I would like to explain our balance sheet. Current assets exceeded the previous fiscal year-end level due to an increase in inventories in response to strong demand related to recycling and minor metals. Non-current assets increased by approximately 7.8 billion yen overall, driven primarily by an increase in property, plant, and equipment resulting from investments by group companies in the manufacturing segment, as well as an increase in investments and other assets associated with a rise in the market value of securities. Current liabilities exceeded the previous fiscal year-end level as trade payable and short-term borrowings increased in line with higher sales and inventory. As for net assets, both valuation differences on securities and retained earnings increased. The equity ratio and net DE ratio remained broadly at the same level as at the end of the previous fiscal year. Next, we present the cash flow statement. Operating cash flow was lower than the previous fiscal year due to an increase in inventories related to minor metals and recycling. Investing cash flow was lower than the previous fiscal year, partly due to real estate sales, resulting in a lower net investment amount. Financing cash flow increased significantly due to higher short-term borrowings. Cash and deposits exceeded the previous fiscal year-end level as domestic group companies sought to control balances through CMS utilization, while cash and deposits held by overseas group companies increased. This slide shows the non-ferrous metals market and exchange rate trends. Although the outlook remains uncertain due to geopolitical developments in the Middle East, throughout FY 326, aluminum, copper, and nickel market conditions all showed positive trends for our business environment. This concludes my explanation of the financial results overview.
From here, Mr. Suzuki will explain the earnings outlook for the fiscal year ending March 2027. As shown on page 13, the full-year earnings outlook for FY 327 is as follows. Net sales are expected to be 235 billion yen, operating profit 10.7 billion yen, ordinary profit 10 billion yen, net income for the period 6.6 billion yen, and EBITDA 15.7 billion yen. The company plans to increase the dividend per share by 3 yen from the previous fiscal year to 90 yen. Next, I will explain the full-year earnings outlook by segment. We will now explain the full-year earnings outlook for FY 327 by segment. First, for the electronic and advanced materials business within the trading segment, we expect sales of 35 billion yen and segment profit of 2 billion yen. Taking into account inventory procurement risks due to geopolitical factors and the resulting decline in sales volume, segment profit is expected to decrease year on year. For the aluminum and copper business, we expect sales of 95 billion yen and segment profit of zero point 0.5 billion yen, representing an increase in profit. As aluminum and copper markets recover, we will steadily capture demand while carefully assessing supply risks. In addition, through the management integration of four group companies, we'll improve productivity and efficiency, thereby enhancing profit margins. Next, in the manufacturing segment, we expect the equipment and materials business to record sales of 61 billion yen and segment profit of 2.5 billion yen, representing an increase in profit. We expect growth in demand for copper materials, mainly for semiconductors and switchboards in the North American market. Finally, in the manufacturing segment, we expect the metal processing business to record sales of 44 billion yen and segment profit of 5 billion yen, representing an increase in profit. We expect growth in chip mounter parts, driven by increasing demand related to AI and data centers. In addition to strong transactions in battery stamped parts, we will also capture demand from the aerospace and defense sectors. Next, I would like to explain our shareholder return policy. DOE is currently targeted at 4% or higher, and the projected annual dividend for the fiscal year ending March 2027 is 90 yen. For past trends, please see page 15. This concludes our explanation of the financial results overview for the fiscal year ended March 2026 and the full year earnings outlook for the fiscal year ending March 2027. Next, I will explain the progress of the Long-Term Management Plan 2030, which we formulated last year. Please refer to the materials at hand. Both the fiscal year ended March 2025 and the fiscal year ended March 2026 exceeded the planned figures. Regarding the outlook for the fiscal year ending March 2027, while the target ordinary profit under the Long-Term Management Plan 2030 Nimaru Sanmaru announced last year was 11 billion yen, we have now revised it to 10 billion yen. The main reason for this is that the full-scale launch of Sud Kansas's North American operations, established at the end of January 2024, has been significantly delayed from the initially expected timing due to the slowdown in EV demand in North America. Meanwhile, the likelihood has been increasing that components produced at the same plant will also be used in storage batteries for data centers. And we will continue to closely monitor this trend while establishing a system capable of responding to future demand. Furthermore, in line with the decline in profit at each stage, we've also revised our ROE target from 12% to 10.6%. As a main growth investment initiative for the fiscal years ended March 2025 and 2026 in the aluminum and copper business, we acquired land in Hanyu City, Saitama Prefecture, to establish a new resource recycling yard as part of efforts under the Long-Term Management Plan 2030 Action Plan to realize a recycling-oriented society by expanding recycling centers and rolling them out nationwide. In the equipment and materials business, amid the advancement of domestic supply systems for semiconductor-related equipment and components in the Chinese market, demand for plating materials is increasing. To capture this demand, we established a new plant in Tongling City, Anhui Province, in April 2024 as a subsidiary of Universal Holdings, Inc., a group company. Currently, we are gradually increasing production volume toward full-scale operation in mid-2027. In the metal processing business, in particular amid recent demand related to AI servers, we've identified relevant areas among the 17 strategic fields proposed under the government's Japan growth strategy that are considered relevant to our business. In order to respond to growth in the materials industry and components and parts manufacturing industries related to those fields, we will continue to proceed with the construction and expansion of group company plants as well as capacity enhancements. Although we have lowered our near-term profit targets, in order to achieve a solid and stable earnings base and sustainable growth, we will pursue both efficiency and transformation in our business operations. Next, I will explain our management approach with awareness of capital cost and stock price. First, regarding capital cost, the company adopts WACC, weighted average cost of capital, and we recognize the current WACC to be approximately 7%. To improve capital efficiency, we have been promoting the sale of idle assets and investment securities over the past 2 years. Our return on equity, ROE, which was 8.6% in the fiscal year ended March 2025, improved to 9.6% in the fiscal year ended March 2026, and is expected to reach 10.6% in the current fiscal year. ROIC, which was 3.9% in the fiscal year ended March 2025, improved to 4.2% in the fiscal year ended March 2026, and is projected to reach 5.9% in the current fiscal year. In order to ensure that profitability exceeds cost of capital, we first introduced ROIC as a performance evaluation indicator at the standalone parent company level and are gradually expanding its application to group companies as well. We will continue to promote business operations that achieve both growth and efficiency. Starting from page 19 of the materials, we will explain the progress of the Long-Term Management Plan 2030. The evaluation for the first year of the Long-Term Management Plan 2030 is shown using symbols such as circles and triangles. We recognize that the action plan set forth has been steadily implemented as a whole. At the same time, we fully recognize the challenges identified to date and will continue to make improvements from the second year onward. Regarding the second theme of our business strategy, maximize value creation through business reorganization and collaboration across the group, we decided in February 2026 to integrate 4 subsidiaries in the aluminum and copper business. This will improve profitability by reducing redundant functions and generating economies of scale. In addition, we are promoting structural reforms in parts of both the equipment and materials business and the metal processing business, and are gradually advancing reorganization toward optimization within the group. Regarding the second theme of our business strategy, focus on businesses where growth markets align with the value provided by the group, centered on the manufacturing segment, which drives our business performance, we are continuously investing in growth areas, as explained earlier. As a stepping stone for medium-term growth, in addition to the planned resource recycling yard in Hanyu City, Saitama Prefecture, which will be the first base in the Kanto region, we have designated the Indian market, which is expected to grow going forward, as a key strategic area, and established a local subsidiary in May 2026 to build a business foundation rooted in the local market. This concludes our presentation on the financial results for the fiscal year ending March 2026. Thank you for your attendance.